Good evening, everyone. I am Debbie Maurice A. Tubo. Allow me to give background information for Bill French case. Bill French was a staff accountant in Duo Products Group. He used to report directly to his boss, Wes Davidson, who is a controller. Bill wanted to use break-even analysis for the planning procedures, which was the first of its kind for the Duo Products Group. Basically, what French has done was to determine the level at which the company must operate in order to break even. As he put it, the company must be able to sell a sufficient volume of goods so that it will cover all the variable costs of producing and selling the goods. Further, it will not make a profit unless it covers the fixed costs as well. Third, the level of operation at which total costs are just covered is the break-even volume, which should be the lower limit in the planning. From the accounting records, we know that the plant capacity is at 2 million units per year. The past year's level of operation is at 1.5 million, meaning the plant is only operating at 75% of its capacity. Average selling price is 7.2 and the variable unit cost at $4.5. The total fixed cost is at 2,970,000. If we will follow through with Bill's computation, given the selling price is at 7.2 and the variable cost is at 4.5, each unit can contribute 2.7 to the fixed cost. This 2.7 represents 37.5% of sales left to cover the fixed cost. Since the fixed cost is at 2,970,000 and the contribution margin is at 2.7, the break-even units will be at 1,100,000. If the break-even point is multiplied by the selling price, the break-even point in dollar sales is at 7,920,000, which is the needed sales in order not to gain or lose. From observation, Bill French graph is analysis. He plots the minimum and maximum cost. The minimum cost is 2,170,000, which is the fixed cost. And the variable cost, assuming at 100%, is at 9 million. This gives a total cost of 11,970,000, including the fixed cost. Next, he plots the sales. The minimum sale is 0 and the maximum based on its capacity is at 14,400,000. Third, he identifies the break-even point at 1,100,000 units at $7,920,000. From the data, he identifies that the margin of safety is 400,000 units. It is computed as sales current, which is at 1,500,000, less break-even point, which is 1,100,000, or at 26.67%, or an equivalent of $2,880,000. All the data to the right from the break-even point pertain to gain, while the break-even to the left pertain to the operating loss area. So question number 1. What are the assumptions implicit in Bill's French determination of his company's break-even point? These are the assumptions that Bill French has made in determining the company's break-even point. First, he has considered the same break-even point for 3 different product lines by taking the average. The company deals with 3 different product lines, namely Product A, Product B, and Product C line. These different product lines distinctly differ in their overall orientation regarding their sales and pricing. Further, French has assumed that the availability of the variable cost is constant. Similarly, there is an assumption that the fixed costs are totally fixed over a full range of operation, and there is considerable reliance in French analysis that sales price will remain constant. Question number 2. On the basis of French revised information, what does next year look like? These are the considerations for the revision. Volume of product A is reduced to two-thirds of the previous operation. The volume of C is increased by a quarter of 1 million, meaning 250,000, and it will absorb the lost volume of product A. Therefore, volume C will be increased by 450,000. By 450,000. Volume B will remain the same. The selling price of product C will be double. The company will incur additional fixed costs amounting to 7,200,000, which is 60,000 per month. The variable cost will increase due to the union demands at 10%. Now, there are assumptions brought by taxes, dividends, and product emphasis. From the case, it is stated that A will operate at two-thirds of its original volume, which is to be absorbed by C. I mean, the loss from the two-thirds. So one-third of it will be absorbed by C. And C would also increase its volume by a quarter of 1 million, making its total sales volume at 950,000. As stated in the case, it is likely that we will pay additional variable costs to the union, which will affect the cost across the board. So the variable cost has been adjusted by 10%. From the data provided, the break-even point will be computed as follows. Adjusted fixed cost divided by adjusted contribution margin based on the sales mix. To break even, the company needs to sell at least 1,145,963 units. The dollar amount will vary since there could be discrepancies with the rounding off, but it's expected that they should have a revenue amounted to 7,963,065 and $84 to break even. In case the union will be ignored, which corresponds to the 10% increase in variable costs, and pay the additional dividend, we will have to compute the expected income. According to Ms. Fraser, they pay a yearly dividend of 300,000, but they are planning for a 50% extra, which means an additional 150,000. They wanted to have 150,000 to be retained in the business. However, according to her, they wanted to have 600,000 after tax. Since they are taxed at 50%, so they need to have an operating income before tax of 1,200,000. Total fixed cost plus the desired income total 4,890,000. Therefore, they need to sell at least 1,373,595.51 units to break even. Same scenario here, except that the union demands will be acknowledged and the 50% extra bonus will be ignored. The contribution margin will decrease since the variable cost will increase by 10% as expected arising from the union. With such data, it is expected that a target profit of 4,590,000 and the company has to sell 1,425,466 units, which is higher than the previous discussion in letter B. In case both the demands of the union and the bonus will be acknowledged, the company has to sell more units to break even since the contribution margin will be lower while the target profit will be higher. With a contribution margin of 3.2 and a target profit of 4,890,000, acknowledging both demands would really cause a lot of pressure for the company to sell 418,634 more units than before all the adjustments were made. Thank you for listening. For the continuation, kindly head over to the presentation made by Ms. Hannah. Thank you.